Hey everyone, this is Kirk here again at Option Alpha, and this is a quick video that I wanted to send out to you guys just for members. So I'm not publishing this anywhere. This is obviously one of the perks of the membership here, but I just finished earlier today jumping on a conference call with a bunch of other people with Dr. David Kelly, who is the Chief Global Strategist for JPMorgan. And what's important about this is that, one, this guy has been in the business for a long time. I mean, he's been with everyone from Putnam Investments to Lehman before they went crazy, right? And he's been on CNBC. He's the main guy for JP Morgan when they talk about global strategy, market insight, everything. So he was having a call today. I got invited to join the call. There's a lot of other people on the call, and we got to do some Q&A with him, which was really good. Unfortunately, the screener didn't like my questions I was going to ask, or she would have called on me, but there was a lot of great information that he relayed in the call regarding everything from the fiscal cliff, housing market, where to invest your money, different opportunities that might not be as forefront as people are starting to look at the markets post-election. And so the whole idea was, okay, now that the election's done, we know who's in control, where do things go from here? So I have some notes, and I wanted to share those notes with you guys while we talk about what Dr. David Kelly had said. So in no particular order, this is just kind of how he went over everything. And again, I'm just going to share the insight that I took down with you guys and kind of bolded some of the more important information. So what he had said is that there's been about 9 years of the same political makeup that we've had recently in the election. So Democratic control of the White House, Democratic control of parts of the houses of Congress. So whether it's Senate, House, whatever. On those 9 years that we've had the same political makeup that we have now, there's been 15% average growth in stocks and 3.2% GDP growth rate on average. Now it's actually fairly higher than the long-term averages for the S&P, and same thing for GDP. So what this really suggests is that we could be in for a pretty nice year for stocks and the economy if we look at the long-term averages. Taxes are definitely going up. The Democrats have more seats in the House, in both houses. Even though they didn't regain control, they definitely added seats and took seats away in both the Senate and the House from Republicans. So they have more bargaining power as we start to head towards this fiscal cliff argument, right? So let's keep that in mind. Taxes are definitely going up. It's going to affect most of us. Going cold turkey on the deficit will kill the economy. And he kind of echoed this a lot before, and I've done some reading of his going into this election, and what he was saying is that the deficit should only really be reduced by 1 to 2% at most each year. So we can't just cold turkey cut the deficit out like a lot of people want. Now look, myself, I think the deficit should definitely be cut dramatically, but I do see as a point that if we continue to cut it at such an exorbitant amount, we risk stalling whatever growth we have, good, bad, or indifferent. Now the deficit should grow on par with GDP growth, and this is actually good growth and leverage. Now look, I agree with this. If the deficit is growing at, let's say, 2%, but the economy is growing at 2%, then we're actually using additional growth and leverage to grow the economy, right? It's not that we don't ever want the deficit to be growing at a faster rate than we're growing. It means we're taking on too much debt to keep up with our own growth. He thinks we'll definitely avoid the fiscal cliff. I think that absolutely as well. I think that they'll reach a deal no matter what. I think a non-deal is horrible for both parties, and they don't ever want to be put in that situation. He thinks it's most likely going to be a just-in-time deal, meaning it's going to be right before the end of the deadline on the 31st and the new year. I tend to think it actually might roll over past the deadline until they actually agree on something. He says that the deal might come in 2 stages and focuses on deductions. So what this means is that they actually might agree to a deal that's only 1 year, so a 1-year deal, and then they agree to relook at it again in another year. Oddly enough, that's what they basically did last year in August of 2011, where they said, okay, we're just going to extend it for the next year and a half, a year and a couple months, and then we'll take a look at it again. So it seems we're kicking the can down the road here a little bit, but as long as they get a deal done, I think that's the biggest thing. Once there is a deal, equities will rally and bonds will fall quickly. And I tend to favor this as well. Think about the sentiment that we've just seen over the last couple of weeks where stocks have been falling dramatically. Bonds have been fairly stable and improving. But as soon as we get this level of uncertainty past us, then we should start to see stocks rally pretty considerably. Relative value of stocks is still very low. We know this from a lot of other discussions that we've talked about. Once we're past this tail risk of the fiscal cliff of the fiscal cliff, bonds should long-term fall, meaning interest rates will definitely start to rise. Sell capital gain assets before the end of the year. Take the lower tax rates now and don't gamble on tomorrow. Again, taxes are definitely going up. Capital gains and dividend income is absolutely on the plate or on the bargaining board right now. So if you have some of those gains that you wanted to lock in and you wanted to pay tax on, do it now before the end of the year and don't gamble that they may or may not be thrown in at the end of the year. He had a lot of interesting points about gold. The biggest point that I think he had was this, that he said gold has no industrial use and therefore is extremely or very speculative. Invest in a basket of commodities tied to overall global growth. So what he was really talking about here at this portion of the call was that in a lot of emerging markets, in markets where they're seeing a lot of growth, Brazil, China still, some of the African countries, that what they're actually buying is a lot of iron, copper, those types of things. Some of the more commodities that have industrial use. Gold is simply speculative, and it's only worth what somebody's going to buy it for, right? It has no other use outside of jewelry and some other things, but no industrial growth use. He talked about buying bonds with short durations, which are best because they're going to hurt less by higher tax rates than, say, long duration corporate bonds. And this makes sense, right? So the shorter the duration, the more quickly you get paid on your dividends and your payments and your coupons. So buy things with short durations because they're going to have less of an impact on overall rates. The last two things are housing and the deduction. So he was very positive on housing. He said supply demand will cause a massive building to keep up with population growth. Currently, we're only at about 800,000 units per year. And what they actually need just to keep up with the population growth in this country is about 1.1 million units of housing needed per year. And we've actually been below that level for a couple of years. So you can start to see how there's becoming this huge undersupply of housing in the market. And what that's going to mean is higher prices regardless of where rates go and higher rents regardless of where rates go. The last thing is this interest deduction removal. He doesn't think even if it is included, and it's still on the table right now, that even if it is included, that it won't cause a big impact in rates because deductions have already been so low with interest rates. See, people have already refinanced into lower and lower rates, therefore their interest is very low already. So removing the deduction, although I think it would be horrible, would be a very minimal impact on housing, or at least less than what people really think it's going to be. So again, these were my quick takeaways from the call. It was about an hour and a half to 2 hour call. Very interesting, a lot of good comments on there, but these were kind of the main points that I thought you guys should have and that I want to pass along to members. So as always, keep looking out for updates. Hope you guys enjoy these, and please reply back, add comments, let me know what you think about these to know if I can continue to do these and get on these calls if this really helps you guys. As always, hope you guys enjoy and happy trading.